Hi guys, this is Dan from the Investment ABC, and in this video I want to talk about whether the stock market is still overvalued after this 20% drop from their all-time highs or not. To figure this out, we are looking at some key metrics. Number one is the current S&P 500 PE ratio. What is the PE ratio? The PE ratio is just the result of the price of a share divided by the earnings per share. If earnings are the same but the price goes up, the PE ratio increases, and if earnings are constant and price goes down, the PE ratio declines. If the share price is stable and earnings decline, the PE ratio increases, while the other way around, when earnings rise and price is stable, the PE ratio declines. But what does the PE ratio really say about when to buy a stock? The PE ratio just tells you how many dollars you have to pay for a share to receive $1 earnings from that share. Say you buy a share and the PE ratio is 20, that means you are willing to pay $20 to get $1 of earnings from that share. That means the lower the PE ratio, the more bang you get for your buck and the more undervalued the company is. You have to pay attention that if you compare shares with the help of the PE ratio, compare shares in a similar industry, otherwise you would compare apples to pears. Tech stocks, for example, they have a higher PE ratio than utility companies, for example, because investors expect the earnings of the tech company to grow more so that the PE will decline sometime in the future. The first company is a growth company and the second one a high dividend company. So you can't compare these two. According to this chart from multiple.com, the average PE ratio of the S&P 500 in the last 100 years was 15.73. And currently, as of the 27th of December 2018, we are trading at 18.55. According to this indicator, we are still above the average, but came good down from a PE of 25, which we had on the 1st of January of 2018. Like every indicator, you can't just look at it isolated and base your decision on it. The PE ratio has a significant weakness. It is based on the last earnings report, but the stock market itself is a forward-looking market. The stock market is more about speculating how earnings and therefore the PE ratio will develop in the future, rather than the current level it is trading right now. We can, for example, see in the chart that we hit an all-time high PE ratio of 70.91 on the 1st of January of 2009. We had the recession of 2008 and the earnings of the major companies were collapsing, so the PE ratio reached its all-time high in 2009. What happened was that investors were so fearful they projected these earnings into the future and therefore missed the bottom in March of 2009. Investors who just looked solidly at the PE ratio, they missed out the bottom. And number two is the Shiller PE. The Shiller PE is named after Robert Shiller and is an improved version of the PE ratio. The Shiller PE is looking at the earnings of the S&P 500 for each year of the last 10 years and adjusts them for inflation. After the adjustment, you have to sum up these earnings and divide it by 10 to get the average. You take the current price of the S&P 500 and divide it by the average earning to get the Shiller PE. If we look at the chart, we can see that the current Shiller PE is 27.52, and even after the recent crash, still only slightly lower than the peak in the Great Depression. Only during the dot-com bubble we had a higher number. If I look at the chart of this recent crash, it looks similar to 1931 and 2000, where it was just the beginning and way lower numbers were about to follow. After the crash of 1931, we came down from 30 to roughly 6 to 7 in the Shiller PE, and in 2000 from 45 to 15. We can definitely not say that we are undervalued at this point when the historic average is at 16.59. Number 3 is the Buffett indicator. The Buffett indicator is also called the market cap to GDP ratio. It is the value of all public stocks in a country divided by the GDP of that country. The stock market cap to GDP ratio has become known as the Buffett indicator in recent years, as Warren Buffett commented to Fortune magazine that he believes this is probably the best single measure of where valuations stand at any given moment. The numerator is the Wilshire 5000 stock index and the denominator is the nominal quarterly GDP. The historic average is 75% and currently we are at 143.8%. A number above 100 signals that the stock market is overvalued, while a number below 100% is considered as undervalued. According to Warren Buffett and his indicator, we are the most overvalued since creation of this indicator. Probably that is the reason why Warren Buffett held the most amount of cash in Berkshire Hathaway's history until August 2018, although he doesn't like cash at all. Maybe he's buying this dip right now, so I don't know. What do you guys think? Number 4 is the comparison between the 10-year Treasury bond yields and the S&P 500 dividend yields. As an investor, you want always the highest return with the lowest risk for your money. One of the safest investment vehicles is the 10-year Treasury bond, because we know that the US government can always print money and pay the investors no matter what. This is the classical thinking, no matter if it is right or wrong. That is why it is crucial to compare the 10-year Treasury yield with the dividend yield of the S&P 500. If we look at these two charts, we can see that over time there are periods where the 10-year Treasury yield is higher, and there are also periods where the S&P 500 dividend yields are higher. In my opinion, this comparison is one of the most important indicators to have a feeling whether the stock markets are overpriced or not. Here on the left side, we can see the chart of the Dow from 2014 until now. And on the right side, I wrote down the yields of the 10-year Treasury bond and the dividends of the S&P 500 over that same period. What is interesting is that by the end of 2014, the 10-year Treasury yield was significantly higher than the dividends of the S&P 500, so that the Dow closed the year 2015 lower than it started. By the end of 2015, the 10-year Treasury yields plummeted and were lower compared to stock dividends, so that the stock market began to rise again. When you look at the end of 2017, we can see that once again the 10-year Treasury yields were significantly higher than stock dividends, which led to a decline in the stock markets. Currently, despite the crash in equities, the 10-year Treasury yields are higher than stock dividends, which makes me think stocks will continue the downwards trend. Especially when I look at other indicators like the yield curve, which is suggesting that we see a recession soon and that earnings and dividends might start to decline in 2019. So when did this recent crash get really ugly? The recent crash started around October 2018 with a spread of 1.27% between the Treasury bond yields, which between the Treasury bonds, which were yielding 3.15%, and the S&P 500, which had a yield of 1.88%. Even after the recent crash, the spread between these two yields is 0.61% and higher than in the end of 2017 with 0.59%. Number 5 are the interest rates. You can see in this chart that the Fed started to raise rates in the end of 2015. And the most important thing which you can learn from this chart is that the interest rate level from where recession starts is getting lower and lower. During the dot-com bust in 2000, the Federal Fed target rate was at above 6%, while the next recession in 2007 began when interest rates were above 5%. So it is most likely that the Fed will trigger the next recession at the level below 5%. The unwinding of QE and the beginning of QT is the next major indicator. The next problem for the market is the unwinding of QE. QE began in December 2008 and ended in October 2017. During this period, the Fed increased its balance sheet to $4.5 trillion in treasuries and mortgage-backed securities. Since October 2017, the Fed began quantitative tightening, where they reduced their balance sheet by $50 billion per month. If the Fed keeps that monthly amount of $50 billion, the Fed would need 7.5 years to completely unwind the balance sheet. I don't think they can do that this long before the economy hits the wall and they have to start QE4 or let the economy collapse totally. So the Fed is taking away its drug, and on top of that, they make it harder for the drug addict to get more drugs by increasing the interest rates. Maybe I'm missing something, but my logic tells me that the economy, so the drug addict, won't like what the Fed is doing and most likely fall ill, or worse than that, die completely. We can see that since the Fed stopped QE, the market fell ill during 2018, and if the Fed continues this path, the market will maybe die in 2019. Number 7, the stock buybacks will most likely slow down in 2019 because of the higher interest rates and the fact that the stock market stopped rallying. CEOs are scared to get the blame when the market continues its decline. That is what these companies always do, either buy other companies' shares or their own shares at overvalued prices. It's the fear which prohibits them to buy cheap and the greed which leads them to buy high. Number 8, the yield curve is flattening and soon about to inverse, which is a major indicator for predicting a bear market and a recession. If you haven't, check out my video about the yield curve where I explain why it is the number 1 indicator to predict a recession. Number 9, the housing market. The housing market is slowing down around the world due to rising interest rates and banks being tighter on lending money. Some high-flyer property markets like London, Sydney, Hong Kong, Vancouver and Toronto are experiencing a severe decline. When the house prices rise, most people feel wealthier and tend to spend more or take some equity out of the properties to finance a new car, holidays, a new iPhone, or they buy shares or cryptos. On the other hand, when house prices start to decline, people worry about paying their mortgages and spend less, which will have an effect on the economy. Number 10, Brexit. The European Brexit is looming in March 2019, and no one really knows what will happen when the UK leaves the European Union. But one thing is for sure, the stock markets hate uncertainty. Number 11. Until now, in every rate cycle, the Fed kept raising rates until the moment they created another crisis, which gave them the reason to decrease rates again. So we can expect more rate hikes in 2019, in my opinion, until something breaks in the economy. While my analysis tells me that the stock market is still overvalued, President Trump advises the people to buy the dip. Maybe I should trust him because, hey, when did a politician ever lie? My view on the president is that he was chosen to be the scapegoat for the financial chaos to come soon. The people will blame him for losing their money when the stock market begins to crash further. If you still want to buy this dip and think stocks are doing great in the long term, I just want to show you some charts of stocks you most likely know. The first 2 charts are from Intel and Daimler-Benz, 2 major and well-known companies. If you would have invested in the year 1999 to 2000, you would still be not break even 20 years later. At least the dividend payments were there to ease the pain during this time. The next 2 companies are General Electric and Deutsche Bank, and I am sure those investors who bought 20 years ago, these two companies will tell you that think twice before buying stocks. I don't want to bash long-term investing in stocks because there were fantastic performing companies like Apple, Microsoft, or Amazon, but it is not easy to find these companies. You clearly have to have a plan about what you're doing. If you can't analyze stocks yourself, buy an index fund, which is safer. Just inform yourself what happens with that ETF when the issuer goes bankrupt. Also, it is important to check the historic valuation levels before you buy. Don't get misled by people who say, oh, this time is different. The markets can stay irrational for a long time, but when they get sober, you better watch out. I really hope I was able to explain why I'm not buying right now and remain bearish until I think we reach undervalued levels in the stock markets. If you learned something and want to support my channel and also like the video, please press the like button and subscribe. If you have also friends and family members who are thinking about buying the dip right now, please share this video with them so they have also another perspective compared to most other YouTubers who are very bullish right now. Still, I would love to hear your opinion. Is this stock market overvalued or not? I hope we have some lively discussions here, and I hope to see you guys soon. Bye. And like always, this is no financial advice. This video is just for pure entertainment purposes only.